Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Not-for-Profit Accounting and Auditing, Spring 2021 Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters, Jennifer Price, partner at Moss Adams, and Hilary Tanneberg, Senior Manager at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Jennifer to get the presentation started. Jen?
Thank you, Amy. Good morning, everyone. Thank you very much for joining us. We're happy to have you here today. What our learning objectives are for today, we are hoping at the end of this session you'll have a good understanding of the changes to accounting requirements and financial statement presentation as a result of what's going on with the current economic environment and all the various programs under the CARES Act. We know there's been a lot of different programs, grants, and funding opportunities that have been very beneficial, but have also required a lot of regulations, different reporting and compliance requirements, and really have raised many questions on how to account and report for them. We'll also describe new and recent accounting guidance for not-for-profits and higher education organizations. We'll talk a little bit about new and upcoming audit standards and when those will be in effect. And you'll also be able to understand some of the changes to the uniform guidance and how these changes will impact your single audits. As most of these programs show up in your single audit, there's been many questions regarding CFA presentation and some of these programs and just the overall impact on reporting. All right, so our agenda. What we'll talk about when we are going to kick off with a review of the accounting and financial reporting guidance, the impact of COVID-19 and the CARES Act and all of the related funding and programs. We'll then talk a little bit about recently issued standards, a few other noteworthy items and questions we've been getting from our client base. And then we'll end with the uniform guidance considerations and a few updates on single audits. And then last but not least, we will hopefully have time for a couple of questions at the end, so be thinking about those as well. All right. Amy, I think we have our first polling question to kick it off today.
All right, thank you. So our first polling question is to get a feel for the audience we have today, and it is, what type of not-for-profit organization do you represent? A, college, university, B, arts, C, foundation or other grant-making organization, D, health and welfare, community service, E, research institution, or F, other. And we'll give you a few moments to respond. Please click the button next to the answer you choose and hit submit. And if you can't see your submit button, please just enlarge the slide area and it should show for you. And it looks like most everyone has submitted. Everyone's pretty quick today. So here are the results.
All right, thank you. Looks like we have a great mix of different types of organizations today. All right, well, let's dive in. We'll start with the accounting impact of COVID-19 and the CARES Act. And so one area we'd like to start is with a little bit of a PPP loan refresher. This is an area we still get many questions on. In fact, I fielded a couple earlier this week. As now that many of these loans are being forgiven, there's even more questions that arise, even if they aren't forgiven at year end. You know, let's do a quick overview of the accounting. So let's talk a little bit about this as a little bit of a refresher. So remember, there are two primary ways that you can and could have accounted for your PPP loans. And really the FASB or the AICPA has not indicated any sort of preference for this. You might recall the AICPA did issue the TQA last year on this that was really non-authoritative guidance for both business entities and not-for-profits. And really that gave you these two options here: to account for it as debt under ASC 470, or to do a conditional contribution using the not-for-profit guidance under ASC 958, 605, which many of our not-for-profits are very familiar with. And so what do those options look like? Well, if you're accounting for it as debt, just like you would any other debt, you do recognize the entire loan as a liability on the balance sheet. You do accrue interest and expense that over the term of the loan. One question we've gotten a lot is, do you need to impute a market interest rate because this is only a 1% rate? The answer is no, you do not have to impute a market interest rate because transactions with interest rates prescribed by governmental entities are excluded from the scope of the standard that requires that, which is, I think, ASC 35. So that's what you do there, and then the loan remains recorded as a liability until either of the following criteria are met. Either the entity is legally released from being the primary obligor, so forgiveness is granted, or, of course, you pay off the loan. And so really thinking about what that means for your financial statements, that's very typical with any other debt. Keep in mind, if, as we are now coming up to a lot of June 30 year ends and then 5/31, many of you just had a year end. Remember, if that is forgiven subsequent to year end, that is a subsequent event, so keep that in mind. And then under the government grant or conditional contribution model, you really record this in advance as a liability, a refundable advance, as you would typically. And then, as you know, conditional contributions aren't recognized until the conditions are substantially met or explicitly waived. So where conditions are met over time or in stages, contributions should be recognized as those qualifying expenses are incurred. You know, the one thing in practice I would say, we have seen a lot of variations on what those conditions are and when they're truly substantially met over time under this model. So, you know, as always, I would say work with your auditor and if you're taking this model and ensuring that you're in agreement on the timing of that revenue. And so assuming all other conditions are met, you really need to look at all those conditions and really think about all of them, you know, payroll, headcount, kind of everything that goes into those loan conditions. So nothing to do under this model. Under forgiveness, of course, you've already been recording the revenue over time as conditions are met. And then, of course, if not fully forgiven, you would then reclassify it to debt and reduce that liability as it's repaid. So going on to the next slide. So how does that look presentation-wise? Remember on the statement of activities, when you have that gain on extinguishment, you should report that as a separate item. If you do report an operating measure, you're going to classify that as non-operating, so keep that in mind. And then as far as the statement of cash flows, this is one area, if you're not an organization who otherwise has any debt, it can be easy to miss this because there's zero debt at the beginning of the year, zero debt at the end of the year, so it's just easy to miss it on that cash flow statement. So just remember, you do need to record, you still have a cash flow from that issuance of debt, so you record that down in financing, and then you do have that gain on extinguishment of debt up at the top under operating. So keep that in mind, that you don't miss it in the cash flow. Looking a little bit at the timing of these, I think this is kind of a refresher if any of you have been through this. You know, many are crossing, you know, having two loans with last year's loan, getting forgiven, taking on a new one. And so here's the timing. You know, you had the 8 or 24-week covered period, and then you had 60 days for your loan forgiveness application, 90 days for that lender decision, and then to the SBA. And so forgiveness, again, really should not be recorded until you've been legally released from that debt. One other presentation thing to keep in mind is disclosure. We have had a lot of questions on this as well. You should have an accounting policy on this in your financials. Especially if you're accounting for it as a contribution, really explaining what your policy is and the related impact on your financial statement. So don't forget about those disclosures. Again, even if it's come and gone in one fiscal year, make sure you're being fully transparent about that. All right, Amy, I think we have one more polling question.
All right, thank you. So our second polling question is, how did your organization account for its PPP loan? A, did not take out a PPP loan. B, debt forgiveness when legally released. C, conditional contribution. This is like any other federal grant. Or D, gain contingency accounting. And just a quick reminder that if you would like to receive credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions for CPE. All right, here are the results.
Great, so it looks like a good mix of did not take or has already been forgiven. So thanks everyone for submitting that. Next, we're going to go ahead and dive into some of the federal awards that were given throughout the pandemic. We're going to start with the Higher Education Emergency Relief Fund, more commonly referred to as HEERF. There were actually 3 different disbursements under this HEERF funding, so we're going to go through each of them. I will refer to them as Round 1, Round 2, and Round 3. Apologize in advance for all the different names. So the first one, HEERF Round 1, was under the CARES Act. And this really was dispersed as 2 different pots of money. The first pot was a student aid portion. No less than 50% of your full amount received had to be used for direct emergency aid to students. There wasn't a lot of stipulation on how the students had to spend it. Institutions didn't have to verify how the students spent it. It just needed to be awarded directly to the students. We'll talk later about some changes in how that aid could be dispersed to students, but for this first round, it had to go directly to those students as emergency aid. On each of these, we're going to kind of talk about general rules on how to recognize and report the revenue as well as the expenditures. I think there's a lot of differing opinions and variety on how these should be recognized, so I encourage you to document your considerations and assumptions early, and then also talk to your auditors about it early so that you can all be on the same page prior to the audit starting. So as noted here, when cash is received, the offset should be to a deferred or unearned grant revenue or refundable advance, so it technically would be a liability. And then the grant revenue is recognized as the student aid expenses are incurred. The second portion of the HEERF Round 1 was the institutional aid. So the remaining 50% that was not spent on direct student aid had to be used by institutions to cover costs associated with significant changes to the delivery of instruction due to the coronavirus. I emphasize that because that was a key distinction, that how the money was spent had to be directly tied to significant changes to the delivery of instruction. So while that's very specific, it was actually quite broad. This could be used to purchase laptops for faculty or who else to be working off campus or at home. This could be to expand your Wi-Fi. So there's a variety of things that fall underneath that. The important piece is that management, again, has read through it, the guidance, and they've documented their considerations and also documented how the expenditures do tie to that specific statement. So that's important. That's when we come out to audit, or your auditors come out to audit that federal program, they will be looking for management's conclusions around those types of items. Again, when the cash is received, you would record that liability of deferred or unearned grant revenue or refundable advance. And as barriers or eligibility criteria are satisfied, that is when the revenue is recognized. Again, I encourage you to discuss this with your auditors ahead of time. Some are saying that that barrier is related to spending the student money, so you can actually recognize the institutional aid until the student money is spent, and I've heard a variety of other ways to report it. So again, important that you are discussing this early and that management has taken a look and made their decisions as well. HEERF Round 2, the Coronavirus Response and Relief Supplemental Appropriations Act, CRRSAA. This is approximately $21.2 billion of funding. So this was actually a bigger disbursement than what came through on HEERF 1. Because of the bigger disbursement, institutions were actually getting more money. So under this funding, again, it's a student aid portion and an institutional aid portion. However, this time, the student aid portion was not specifically stated as 50% of the total received. Instead, it said that the same amount had to be awarded to students that was required or would have been required to be provided under its original CARES Act student aid award portion. So whatever you spent under Round 1 on students, on your student aid portion, that's how much you would have to spend under your CRRSAA. It also clarified that eligible students for this funding included non-degree seeking, non-credit, dual enrollment, continuing education, as well as students qualified as aliens as defined within the noted section here. The continuing education was key. Obviously, with the pandemic, many institutions had to shift to an online platform, which in sense made those students continuing education students. Typically, if you were exclusively enrolled in online courses, you're not eligible for financial aid. However, again, under this act, they did come out and say, yes, students who are continuing education now are eligible for this funding. As I mentioned, under round 1, the money had to be dispersed directly to the student. Under round 2, they did say that this could actually be applied directly to the student account. However, you had to obtain written or electronic affirmative consent from the student. Again, this had to be affirmative and it had to be written or electronic. So important that you had a policy in place and that you do have this maintained to show auditors, or if Department of Ed came in, that you do have that on file. This also created a separate program for proprietary institutions where they could actually apply for funding under CRRSAA and receive funding if approved. It also clarified that this money may be applied to charges that were posted to student accounts prior to December 27th, 2020. Further down the road, they then clarified that it could actually be back to March 13th, 2020, when the World Health Organization declared the COVID-19 outbreak a global pandemic. Again, grant revenue is recognized as the student aid expenses are incurred. Looking at the institutional aid under the CRRSAA, this money needed to be used to defray expenses associated with coronavirus. This includes a new concept of lost revenue, as well as employee benefits. When looking at lost revenue, there's a lot of great examples of how exactly you can calculate this. I encourage you to go out to NACUBO's website and look at those examples. There's a lot of ways, they walk through a few different ways that you can calculate that. Some good guidance that NACUBO also gave out is look at what's not allowable first. There's a list of not allowable items, but some include expenditures on athletic facilities, acquisition of real property, alcohol sales, investment income. If your lost revenue does not fall into one of those unallowable cost areas, then it probably is allowable. Also with employee benefits, you need to use your judgment here. This had to be employee benefits could be covered if the costs are newly associated with the coronavirus pandemic. I know I keep saying this, but it's key with both of these items that management really look at what they're doing and document their considerations and assumptions, because it is fairly flexible, the guidance is, and so it's important that auditors are able to read through management's judgments and assumptions and get a clear understanding of how they decided that this was allowable. CRRSAA also said that this money can be used to carry out student support activities as authorized by the Higher Education Act. Some of those student support activities include your TRIO, or the Gaining Early Awareness and Readiness for Undergrad programs, more commonly referred to as the Gear Up program. With all the institutional aid portions, you were always allowed to make additional financial aid grants to students, so you did not only have to spend it on defraying expenses with coronavirus. You could say, we want to award students more money, we're going to go ahead and use part of our institutional portion for that. It also added that indirect costs may now be charged. If you don't already have an agreed upon indirect cost rate, you could elect to use that 10% de minimis rate. The key here is that you aren't double dipping. So whatever you use as your cost basis to be charging indirect costs on, you want to make sure that that hasn't already been charged through another portion of HEERF or another federal award program. You got to make sure that you are keeping those separate and clear, and again, you want to make sure that that's documented clearly, that those are two different populations. Again, as the barriers or eligibility criteria are satisfied, revenue is recognized. So I've touched on this a little bit, but just one final note on recording the CARES Act and CRRSAA HEERF aid is you do want to consider the ASU 2018-08. These are considered conditional contributions. Again, discuss with your auditors. The HEERF grant is conditional because the grant certification limits the university's discretion over how the money can be spent. And again, the student portion contains very specific requirements to provide emergency to those students with financial aid, or financial need, excuse me. For the institutional portion, it does require that there be a clear nexus of either expenses or expenditures directly to coronavirus disruption, and there are also types of expense and expenditure exclusions that could impact being able to recognize that. We'll talk a little further in the presentation, or in our presentation, about how the CFA should be shown. However, as a note here, the institution and student portions do need to be reported separately on your CFA. All of the HEERF funding is under the same CFDA number. However, there is a letter that will identify what specific piece of that money is. So it's all 84.425 is your assistance listing. However, it does need to be reported separately as institutional portion versus student portion, and it also needs to be submitted to the Federal Audit Clearinghouse in that same fashion. The last round of HEERF funding was the American Rescue Plan Act of 2021, ARP, ARPA, heard it both ways. This further clarified that students no longer had to be eligible for Title IV student financial aid to receive these HEERF grants. So under each round of the HEERF, it got a little more broader on what students were eligible. And so now eligible students include all students who are or were enrolled in an institution of higher education during the COVID-19 national emergency. This now includes undocumented and international students, as well as students studying abroad. However, you do still want to prioritize students with that exceptional need and document how you made those determinations. And this is structured similarly to HEERF 2. However, there are some distinct differences. So first, if the entire institutional portion was not used for emergency financial grants to students, there are two items that the funds must be used on. First would be to implement evidence-based principles to monitor and suppress coronavirus. Secondly would be to conduct direct outreach to financial aid applicants about the opportunity to receive a financial aid adjustment due to the recent unemployment of a family member or independent student. That second piece is going to require professional and judgment. So it's important that whoever is in charge of making these decisions is documenting their professional judgment as to why they think these students should be receiving additional aid if that is decided. It also modified the share of the institutional funds that must be used for emergency financial aid grants to students. It's a fairly complex calculation that I'm not going to get into here. Just know that it has been calculated for you all, and you will get it through your G5 if you are eligible. This maintains that separate program for proprietary institutions, so again, they could go apply for funding. Also, the taxability, there's a lot of questions about the taxability of this money. Again, there's some great guidance out on this, but in general, it is not taxable to the student if it was received as a grant. And under each of the HEERF funding, there are specific reporting requirements. 2 quarterly reporting requirements were implemented with HEERF 1 that carried through HEERF 3. There is going to be additional guidance coming towards the end of the calendar year, more than likely, about more specific reporting requirements for the HEERF 3 funding. Moving away from higher education into some of the other programs, the coronavirus relief funds. This provided direct payments to state, territorial, tribal, and certain other eligible local governments. This was used to cover necessary expenditures incurred due to the public health emergency with respect to the COVID-19. It noted that the costs had to be incurred during the period of March 1, 2020 through December 31st, 2020. There was an FAQ issued in October of 2020 that is helpful in providing some guidance on what is allowable and what is not allowable. And institutions or organizations may have received this funding as a subrecipient. So if you did receive some funding from another organization, make sure that you do understand what specifically that funding was. Was it federal? Was it not? If it was federal, what's the assistance listing? What are the requirements? Make sure that you are documenting that and having a good understanding. Next is provider relief funds. This provides funds to hospitals and other healthcare providers. This helps support healthcare-related expenses, or again, lost revenue, this new concept that has come out from the pandemic. And it also helps make sure that uninsured Americans could get treatment for the COVID-19. Expenditures and lost revenue will not be included on CFAs until December 31st, 2020 year ends and later. So that's a little weird in that your CFA is probably going to cover more than 12 months of expenditures, but that is the guidance right now. HHS actually released some updated reporting guidance earlier this week that significantly changed the reporting timeframes and period of availability. There was no FAQ release this time. However, they did release a reporting guideline that I would encourage anyone to go read that does have this funding. We are still pending some updates and information related to how on these HHS updates affect the single audits as well as CFA reporting, so hold on there. Hopefully that will be coming soon. And also released in this guidance is that the provider relief funding reporting portal will be open to providers to start submitting information on July 1st, 2021. That has been some long-awaited guidance, so that's great that they finally were able to come out with that. Again, there's a lot of details around this funding and what's allowable and how it should be reported. So again, I encourage anyone that did receive this funding to go out and read through some of this new guidance to make sure that they are in compliance. The National Endowment for the Arts Coronavirus Aid funding, this was awarded to nonprofit art organizations. Again, this assisted with expenditures due to forced closure of their operations because of the spread of the COVID-19 pandemic. And lastly is the Shuttered Venue Operators Grant. This awarded over $16 billion in grants to shuttered venues. This was administered by the Small Business Administration's Office of Disaster Assistance. Eligible applicants may qualify for grants equal to 45% of their gross earned revenue, and $2 billion is reserved for eligible applications with up to 50 full-time employees. These include theatrical producers, live venue operators, museum operators, etc. So a variety of organizations do qualify for the funding under this Shuttered Venue Operators Grant. Some disclosure impacts around the pandemic. The big takeaway here is that you are considering these specific ones as well as your operations in general that need to be disclosed in order for the reader to have a good understanding of your financial statements and how it was impacted by the pandemic. This is, again, something that I would encourage you to talk to your auditors about early so that you're covering these items before the audit starts and so that the draft financial statements can be completed early. Some areas of focus may be your change in estimates. Part of the audit, the auditors are required to come in and look at your estimates and test those for reasonableness. If it's changed significantly from prior year, that will probably add additional work. So again, that's why I encourage you to speak early with your auditors. Some estimates that could be considered in this are your allowance for doubtful accounts. Are you still able to collect as much as you have historically through the pandemic? Something to look at, whether it's student accounts or maybe even your pledges receivable from donors. You need to go and look at that list and make sure that everything on there is still collectible, or if not, that a higher allowance be recognized. You may also want to look at the fair value of your assets, see if there's any sort of an impairment on any of those assets. Discount rates should be looked at, maybe even some of your accruals. We've seen as a way to reduce expenditures is changing the retirement plan and reducing the amount of employer contributions. So does that accrual need to change at year end from last year? And I think the big key here is that you don't want to just take your prior year and roll it forward and call it good. I think you really need to take a deep dive and make sure that those are still appropriate for the current year. Availability and liquidity, this is a new footnote a couple years ago that's now required to be reported, where it shows what your organization has for the next 12 months to spend on general operations. Again, one to look at. I think this is a great footnote for your readers to really get a good idea of your organization. So you want to take a hard look at that availability and liquidity footnote, make sure it's up to date and accurate, and maybe it will take some tweaking this year or maybe some more words around it to, again, explain how your organization was impacted. Subsequent events. Jen touched on this a little bit, your PPP loan, whether it was funded or forgiven after year-end, that would be considered a subsequent event. Any sort of significant market fluctuations, again, maybe a change to your retirement plan, reduced workforce, there's a variety of subsequent events. So make sure you have a process in place to review for subsequent events and then make sure that those do get properly disclosed. Risks and uncertainties. This one we have been seeing just kind of a general language around how your organization was impacted. Again, everyone by now should know about the COVID-19 pandemic, but not everyone understands how it specifically impacts your organization. So this footnote really gives you the opportunity to explain to the readers exactly how you were impacted and what maybe your plans going forward are to help reduce the further impact. The last one on here is going concern. This is an accounting standard, so this is something that management and the organization needs to be reviewing. The auditors will come in and look at your assessment and make a determination. Again, just something that's going to take time that I wouldn't want you to put off until the end. Make sure you're getting ahead of that analysis and getting it documented, and again, discussing with your auditors about your conclusions around your entity's ability to continue as a going concern. As a reminder, that analysis is not from year end. It is 12 months from the date of issuance. So keep that in mind as you are looking through those considerations. Just a couple other items to consider. Impairment considerations. So again, receivables. So you may already have your allowance calculated, but go back and look at that. Are additional reserves needed? The collectability of items may not be the same as it has been. So again, consider increasing that allowance. And remember, that allowance calculation is just an estimate, and it can be reversed subsequently if facts or circumstances change. So it's not as if you are totally locked into that allowance once you calculate it. So probably better to be a little more conservative if you think that's necessary. Long-lived assets with finite lives. Want to test for impairment following a triggering event. Pandemic may have been this triggering event. The impairment test can be done on an individual asset or the asset group in total. The one thing I want to point out here on impairment losses is that once that impairment loss is calculated, it cannot be subsequently reversed. So you do want to make sure that you're being considerate in that and really taking a deep dive and looking at that. Again, talking to management, talking to your auditors about that to make sure that there truly was an impairment and that the amount is accurate. There are also, as always, a number of disclosures that are required about the nature of the impairment loss. So if you do think that you have an impairment loss, be sure to start looking through those disclosures to make sure that everything is adequately disclosed in your statements. At this time, I'm going to pass it back to Jen.
Thanks, Hilary. All right. It's time to shift gears a little bit and get into our FASB update. There's not a whole lot to talk about considering we've had a few years of a lot of different standards, but there are a few things we'll touch on quickly. ASU 2020-05, this did amend the effective dates for topic 606 and topic 842. So our revenue recognition and our lease accounting standards. First for revenue, really we're sort of down to the private entities that did not adopt last year. So right now it's annual reporting periods beginning after December 15th, 2019. So that is the 21 fiscal years that are happening right now. So really anyone, if you haven't adopted, the time is now. So that should be most everyone at this point. For leases, everyone did get one more year, whether you're public or private. And again, public referring to you have publicly traded debt. So for accounting standard implementation date purposes. So for private companies, it all the way to fiscal years beginning after December 15th, 21. So that's those May and June 23 year ends. So a little bit of time out there for you. For the publics, it is going to be this coming fiscal year, years beginning after December 15th, 19. So your 2021 year end. So these are forthcoming. It seems like we've been talking about leases for a very long time, wondering if we would ever get to adoption, but we are here now. So I'm going to the next one. Oh, it looks like we have another polling question, Amy.
All right, thank you. So our third polling question, will Topic 842 leases be a significant standard adoption for your organization? And your options are A, already adopted and it was a lot of work, B, already adopted and it wasn't a big deal, C, have not yet adopted and it will be a major undertaking, D, have not yet adopted, but we have minimal immaterial leases, so it's not a big deal, or E, haven't adopted and really haven't assessed the impact yet. And also, I want to let the audience know that we are receiving several questions from the attendees, which is great. We do have quite a bit of content to cover today, so if we don't have time to respond to your particular question during the webcast, we will follow up with you afterwards. All right, here you go.
All right, it looks like the majority haven't adopted, but will be minimal or immaterial for you. That's great news for you, but kind of a mix on the other categories. So I think that's what I'm seeing in practice as well. So this one will take some work for some, I believe, and not for many others. All right, so let's move into a couple of other standards. Fair value measurements. So what this one is, this is sort of nice because it's actually taking away. So instead of adding additional fair value measurement disclosures, as we had to do for a number of years, it seems, this is now actually going to minimize, kind of trim down those disclosures and take away a little bit. So we'll take it. It removes the disclosure requirements I have listed here, the amount of and reasons for transfers between levels 1 and 2, your policy on timing of transfers between levels. So that's not a whole lot to remove. You know, it's maybe a couple of sentences, but for those of you that have level 3s, significant level 3s, you can remove those valuation process disclosures for your level 3s. Also, the changes in unrealized gains or losses for your level 3s, that can go away, so that's kind of nice. And then also, there's a little bit of modification as well to the disclosures. Also for your level 3 roll forward, it does change slightly what you're going to disclose. So it's really only transfers in, transfers out, purchases and issuances of those level 3 assets and liabilities. So a little bit different than what we currently have. So that does change that a little bit. And then for your net asset value investments, those that are not in level 1, 2, or 3 in your table, it's disclosing the timing of liquidation and the date when restrictions from redemption might lapse are only required if this has been either communicated to the entity or publicly announced. So that's something to keep in mind and just take a look at that. This is here and now as well, effective for fiscal years beginning after December 15th, 2019, so 2020 and forward year ends. This was early adoption permitted. We did have quite a few clients that adopted this last year. Again, because it's a takeaway, it kind of trims some things down. Otherwise, it's time to adopt for this year. All right, updating the definition of collections. I know this doesn't apply to everyone, but we do have some not-for-profits that have collections, especially in the museum space. We also have quite a few higher education clients that have various collections, you know, some of the art schools and even some traditional colleges and universities that do have collections. And so Take a look if you do have some artwork or collections. So this standard modifies the definition for works of art, historical treasures, or similar that meet these criteria. So they're held for public exhibition or education or research, not for financial gain. So not the beautiful artwork you purchase just to hold and invest in. They're protected, kept unencumbered and cared for, and then they are subject to a policy that requires the proceeds of the items sold to be limited to care of existing collections or acquisition of new collections. So again, you're not selling them for financial gain. So really distinguishing what are they really used for, and really what is your policy. So it does add a little bit of disclosure for these. You do need to disclose your policy for the use of proceeds when those collection items are removed, when they're de-accessioned from a collection. If you allow those proceeds to be used for direct care, you need to disclose your definition of what that direct care is. What does that mean? This one also is here and now, fiscal years beginning after December 15th, 19. This was early adoption permitted as well, but for anyone else, 2020 and forward year ends, this does need to be adopted. Okay, this next one, I think I've gotten the most questions on this one if I'm looking ahead outside of, I'll say, revenue rec and leases. So this one, this ASU is really responding to feedback from various not-for-profit stakeholders who believed gifts in kind were really an area where the reporting could be improved. So this really set out to address those concerns and really require a lot more prominent presentation of these items, enhanced disclosures. And so what this really requires is those contributed non-financial assets, those gifts in kind, to be presented as a separate line item. So they really need to be separately pulled apart from contributions of cash or other financial assets. Many have asked, well, what are these? What are some examples of these? So these are things like fixed assets, land, buildings, equipment, materials or supplies that have been donated, food, clothing, pharmaceuticals, could be intangible assets, and then your recognized contributed services. So keeping in mind, you're meeting the criteria for recognizing contributed services. But if they are, that's another example of what this would include. So this standard adds the following disclosure requirements. You have to disaggregate the amount by category of non-financial assets. So for each category, you need to list some qualitative information on did you monetize them or utilize them during the period. If you did utilize them, you need to describe what they were used for. What are the programs or activities that you used them for? And then also your policy about monetizing rather than utilizing them. So really the standard, I would say, the high-level takeaway I would leave you with is that this doesn't change any accounting. This is presentation, disclosure. And so really think about your policy, and you really need to describe any donor-imposed restrictions associated with these as well. You need to include the valuation techniques and inputs, how you arrived at those fair value measurements, as you would with any other fair value item. Some of these do require an estimation, of course, so you need to describe those evaluation techniques. And then just like regular fair value measurements in topic 820, the principal market or the most advantageous market used to arrive at that fair value measure. If it's a market in which you're prohibited by a donor from selling or using non-financial assets, so keep in mind those donor restrictions on this as well. So this one, I think, is the only one I've talked about that is looking ahead. So fiscal years beginning after June 15th, 2021. So if you're a June 30, 7/1/22, this is on. Early adoption can be permitted with this one, but note that it is applied retrospectively, so looking forward with this. You don't have to look backwards. So let's go, Amy. We do have another polling question for the group.
All right, thank you. So our last polling question is, which of the new standards just discussed will your organization be adopting in the upcoming fiscal year? And all of the options are listed there. If there's more than one, you will want to select E. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And for those that would like a copy of today's slides, you can download those as well from the folder that says slide deck and handouts. And we'll be sending them via email tomorrow, along with a recording of the webcast. All right, we'll leave this up another 5 seconds or so. All right, here you go.
Great, so it looks like almost half of you will be implementing more than one this year. So either that means you're really eager or just required to adopt some of those. So we're going to go ahead and wrap up with some uniform guidance considerations as well as a little bit of a single audit update. So for those of you who don't have a single audit, just a brief explanation here. Once your audit is complete, you are required to submit that audit to the Federal Audit Clearinghouse through the data collection form. That typically has a very strict deadline on when that is due. However, due to the pandemic, there is a 6-month single audit automatic extension. You do not need to seek approval for this extension. Everyone is given the extension, assuming that you have not filed your single audit with the clearinghouse as of March 19th, 2021, and that you do have a fiscal year end through June 30th, 2021. So a little bit of a nice break there for anyone needing that 6-month extension. Depending on when the compliance supplement comes out and any addendums after that, it really does impact how quickly you can get your audit issued and done with. And so again, this is a nice break that you do get an automatic 6-month single audit extension. While not noted anywhere, probably encourage people to go ahead and document why that 6-month extension was taken and just keep that somewhere safe. Just in case, better to be conservative and over-document than to not have anything. When looking at the CFA, we do want to make sure that the COVID-19 funds are specifically identified as such. So in some circumstances, you may have an already funded program, and then under that exact same assistance listing number or CFDA number, you also got some COVID-19 funding. You want to make sure that those are separately broken out on your CFA, and we'll actually look at an example on the next slide. Because of the pandemic, the federal government was just trying to get money out, and so some of the compliance requirements weren't really clear, and also some of that money was actually issued without an assistance listing number. Again, that's more common, or used to be called the CFDA number. However, at this point, everything should have a CFDA number, so if you are still unsure about what your assistance listing number is, I encourage you to go out and find that. At this time, you should know that, because that is, again, required to be reported on your CFA. The non-federal entity, you were required to agree to the terms and conditions or return the funds. And so if you took the money without really understanding the compliance requirements because you needed it and now you're thinking, oh shoot, maybe we weren't able to spend this how we thought, that money does need to be returned. When you drew down that money, in a lot of instances, that was your acceptance of those terms and conditions. So again, want to make sure that you're going back and making sure that you are still in compliance with all the requirements around that funding. Again, when the COVID-19 funds are sub-awarded from an existing program, the information furnished to your subrecipients as well should distinguish whether it was COVID-19 or non-COVID-19, because again, that does have to be separately reported on your CFA, which is what we're looking at here. So you can see your CFA example. You had $3 million of funding under Assistance Listing 93558. However, part of it was COVID-19 and part of it was not. So that's where you have to say COVID-19, and that also will be input into your data collection form when you do submit that to the Federal Audit Clearinghouse. So again, very important that you are putting COVID-19 as a prefix to that program name or on a separate row. So COVID-19 programs, again, are introducing challenges to maybe what we thought was normal. I'm not sure what normal is now, but hopefully we'll get there someday. You know, cash may have been received well before the award terms and conditions were agreed to. So again, making sure that you're going back and looking through that compliance supplement and making sure that you're in compliance with the award terms and conditions. There's this new concept of lost revenue. We've talked about it under two different programs, the HEERF as well as your provider relief. Make sure you're understanding what that means and how you calculate it. General rule of thumb for CFA inclusion, when the underlying activity occurs, is when you record that expenditure on your schedule of expenditures of federal awards, your CFA. If there's an award term or condition that requires that it be on your CFA, and we haven't touched on this too much, but it may not be tied to your GAAP revenue recognition. Under the provider relief funds, for example, again, your CFA is going to include more than 12 months of expenditures, but that's not necessarily how you're going to recognize that revenue. So important that you're distinguishing the two. There is not the traditional matching concept under some of these funds. Lastly, wanted to bring everyone's attention to the FAFATA reporting requirement. Recipients and subrecipients of grants who make subawards of $25,000 or more to subrecipients are required to report this information through the FAFATA subaward reporting system. Originally, for single audits of fiscal year ends pre-9/30/2020, this was only for COVID-19 funding. After year end 9/30/2020, this is extended to all major programs. So if you are passing through $25,000 or more, you are required to report this under the FAFATA reporting system. Your auditors will be looking at your internal control procedures to make sure you have a complete population of your subrecipients, and then also making sure that those are in the FAFATA subaward reporting system. So this is something new that some of you may be running into from a compliance standpoint this year. I think we have time for just maybe a couple questions. So one that came through is in regards to the 6-month audit extension and how does that impact our single audit. This actually has no impact on your single audit. It does not impact your low risk determination, so you can still be a low risk auditee, which is great news. You know, make sure that you are talking with your auditors. Again, maybe you issue 2 separate statements where one's just financial statement and one includes the compliance requirement piece, something, again, to discuss. Jen, did you want to cover the next question?
Yes, thanks, Hilary. I see a few here on PPP loans that I think I can answer, maybe 3 in one fell swoop. One, do PPP loans go on the CFA? No, they do not. I know that has been confusing. It is a federal program like many of these, but you do not need to report your PPP loan on the CFA. I wanted to loop back on the cash flow treatment. There was a question about when I covered showing the proceeds of those loans as a financing activity. Keep in mind that was only under the debt model. So if you opted for the debt model, you follow that all the way to the cash flow, and you show the proceeds and the gain in the cash flow. However, if you did choose the conditional contribution model, it would just be included in your grant or contribution revenue as normal. So there would be no separate breakout on the cash flow. So once you've chosen your model, you just follow your normal accounting for those items under that model. So hopefully that clarifies that. And the third component of it was about recording the accrued interest. Many organizations I know did not record that accrued interest. The interest does get forgiven as well. Yes, you should record it and accrue it and then report it as forgiven. But talk to your auditor, keep in mind materiality. I know many of my clients, it ended up being a really small number given the 1% and depending on the time period. So I would just say, yes, technically you should. and report it as forgiven as well, but talk to your auditor about the significance of the balance. I think we will be wrapped up. I'll turn it back over to you, Amy.
All right, thank you. And thank you, Jennifer and Hilary, for a great presentation today. You were able to give quite a bit of information within the hour, so that's great. And just a reminder to our attendees, if you did attend in a group setting and would like to receive CPE credit, you must complete the group attendance sheet found in the console. And if you participated as an individual and met all requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download, and a copy will be emailed within a few weeks should you have difficulty downloading it now. And here's a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.